Hello, welcome back. In this lecture, we start our tour of financial instruments with money market instruments. Specifically, you will learn about main types of money market instruments. We will talk about federal funds markets and the LIBOR market, the most marketable money market instrument, treasury bills, repurchase agreements, commercial paper, etc. After this lecture, I expect that you will be an expert on money market instruments and the language and the terminology that go with money market instruments, and finally their main features. We will talk about long-term debt instruments in the next lecture. Money market consists of very short-term fixed income securities. It is a very important segment of financial markets as it serves three important purposes. First, it provides investors who would like to invest in very liquid assets, a market where they can do so. Second, it provides those who are in need of short-term liquidity, a market where they can borrow from. And finally, and very importantly, it provides the Federal Reserve Bank, the U.S. Central Bank, a channel to conduct its monetary policy by influencing the availability and cost of liquidity in the money market. Let's start with the federal funds market. In the U.S., all banks are required to maintain a minimum balance of reserves with their local Federal Reserve Bank. These are called federal funds. The amount of reserves that each bank needs to maintain depends on the amount of the deposits that it has. Now, at any point in time, some banks may have more funds or excess funds than they need, and others may be in need of funds. So those banks that have excess federal funds can lend to those that have a shortage of federal funds. The interest rate on these interbank loans, which are typically overnight transactions, is called the federal funds rate. Now, while most individuals like you and I cannot participate in this market, it is still a very important market, and it is still an important rate because it is influenced by Federal Reserve's open market operations to follow a target rate and is therefore seen as a key barometer of monetary policy. Here I have a graph that plots the daily effective federal funds rate, which is basically the average of the overnight federal funds rate computed daily. As you may know and can see in this plot, this key rate has been close to zero for a very long time, since about 2010. Now, the equivalent of federal funds rate in the London money market is the LIBOR. LIBOR is also a key interest rate because it serves as a reference rate to many other financial contracts, such as derivatives, mortgages, commercial loans, etc. Now, interestingly, the LIBOR is not derived directly from actual loan transactions. It is calculated based on responses to a daily market survey of participating banks. It is based on what each bank estimates their interest rate that it can borrow overnight to be. Now, what do you think the issue with LIBOR is? Well, for starters, one concern may be, how truly does the survey-based measure reflect banks' cost of overnight borrowing, especially at times of financial distress? Now, indeed, during the financial crisis, it appeared that banks underestimated their cost of borrowing in order to make themselves appear financially stronger. More importantly, it also emerged that several participating banks were in fact colluding to manipulate the LIBOR rate in a way to profit from their derivative trade positions. It emerged that traders were secretly communicating with each other to ask for higher or lower submissions that would be more favorable to their trade positions. Of course, lawsuits followed subsequently, and several banks had to settle with large fines following these lawsuits. Now, the most marketable of all money market instruments are treasury bills. The U.S. Treasury borrows from the public by issuing Treasury securities. And T-bills represent the simplest form of fixed income securities. Now, Treasuries in general play a special role in financial markets. Because they are issued by the U.S. Treasury and therefore backed by the U.S. government, they are viewed all around the world as default-free assets, or default risk-free. So the interest rate on Treasuries is considered as the risk-free rate for different maturities. For that reason, they are also used as benchmark rates for many other fixed income securities. Now, what are Treasury bills or T-bills? Well, they are essentially zero coupon bonds with less than 1 year to maturity. They are issued at initial maturities of 4 weeks, 13 weeks, 26 weeks, and 52 weeks. So in 1 month, 3 months, 6 months, and 12 months. They are highly liquid, they're easily converted to cash, and they have very low transaction costs. A certificate of deposit, or a CD, is a short-term time deposit with a bank. Time deposits cannot be withdrawn on demand, and the bank pays the depositor interest and principal at the end of the fixed term of the CD. It is also an important money market instrument. Now, commercial paper is a short-term unsecured debt instrument that is widely used by large corporations. Instead of borrowing from a bank directly, commercial papers allow corporations to borrow from the public markets to meet their short-term financing needs. The maturities on commercial paper can be very short as a day, or up to 270 days. Now, while I said that commercial paper is primarily used to meet short-term financing needs, because the current rates have been so low, this has led firms to use this market increasingly for other purposes. So here I have an example from the Wall Street Journal of 2 companies tapping on commercial paper market to finance acquisition deals. Finally, I'd like to tell you a little about the repo market, as this is an increasingly important market for traders to borrow and lend cash on very short-term basis. So what is a repo or repurchase agreement? Well, essentially, it is the sale of a security with a promise by the seller to buy the security back at a given price at a given date. So for example, the dealer sells T-bills to an investor on an overnight basis and promises to buy them back the next day at a slightly higher price. And the increase in the price is the overnight interest. And the T-bills serve as the collateral on this loan, basically. A reverse repo is the opposite of this transaction, where the dealer finds an investor with Treasury bills, buys them back from the investor with an agreement to sell them back on a higher price on a future date, probably just not the next day. Essentially, repo agreements are collateralized short-term loans where the collateral is a security or a pool of securities. So in this lecture, we looked at money market instruments. You saw a wide range of money market instruments ranging from interbank loans to Treasury bills, CDs, commercial paper, and repurchase agreements.